Well, hello, everybody. Steven Sitkowski here once again. Welcome to this week's Market Insights. And boy, we got a bunch to talk about. The market has been ripping post-election. If you're following the market at all, I know you're already aware of this, but it has been a pretty amazing short-term run. Of course, the question is, how long can it continue? It'll be fun to watch. I want you to know that everything that I do here is for educational purposes only. It is not intended as investment advice. It's just kind of my observations of what's happening out there. So what's moving the markets? Post-election, the market has just been on fire. And you might wonder, well, why is that? Well, I think there were some very different policies that were put forth by each of the candidates. And the market prefers the policies of President Trump, at least in the short term. They're more pro-business, probably less regulation, lower taxes on corporate America. All of those things are perceived as good for the market. And the market has responded. Tesla ripping higher. Now, who was one of the main supporters of President-elect Trump? Elon Musk. So Elon now has friends in high places. And as a result, that is considered to be a real positive for Tesla. Crypto stocks, Bitcoin's over 82,000. So there is a particular trust, GBTC, G like George, B like boy, T like Tom, C, that owns Bitcoin. I happen to own that shares in that particular trust, but that's a way of playing it. And then crypto related stocks are doing great. Mara, Riot, all of those. And Trump is perceived as the crypto president. 10-year treasury is pretty stable at 4.3-ish. And oil prices have fallen again back below 70. Kind of surprising. What to watch this week? Today's Veterans Day. Tomorrow, mostly Fed speak. Wednesday, we get our CPI numbers, both headline as well as core. And we're expecting core CPI to come in at 3.3% annualized. And actually for the headline number to tick up a little bit from 2.4 to 2.5 on the strength of the economy. So that's potential market mover. Thursday, we get the initial jobless claims, supposed to come in at 225,000. You get the producer price index, which is inflation at the wholesale level, supposed to move higher at 0.2%. And then core PPI last time around came in at 0.1%. So we'll see what that looks like. And then on Friday, retail sales, kind of a proxy for the economy. Industrial production numbers comes out. So all in all, a fairly busy news week. Could have some influence on the market. Last week's heat map, a whole lot of green, except for the drug companies are kind of running scared, kind of waiting to see what President Trump has in store for them. And we've seen a move out of some of the more defensive stocks, consumer staple stocks, and everything is going into higher risk. Look at Tesla. up 47%. Are you kidding me? So whatever it was that Musk spent in helping the president, he has recovered billions upon billions upon billions. Is it good or bad? I don't know. Is it good or bad that movie stars and entertainer align with a particular candidate? It's just how things are. It's all advertising. If you want to sell a sneaker, go get Michael Jordan. If you want to win an election, I guess you go get, Elon Musk, or on the other side, a Beyonce or a Taylor Swift. Frankly, I don't know. I would hope that nobody's vote gets influenced because a pop singer says, this is who I think you should vote for, but I don't know. there's so much, as I look around the world these days, that just does not make sense to me. Personally, let me throw this out and then I'll hit you up with the 1-year heat map. Personally, I think the way that election ads should be handled, both candidates get exactly the same amount of money. I don't think your ability to occupy the White House should be based on contributions and how much you can afford to spend on ads. That just doesn't make any sense. If one person can raise more money than the other, run more ads than the other, then they get a better chance to occupy the most prominent position in the world. That is just dumb. You need to equalize all of that. You need to have candidates that don't collect contributions from any special interest group. So maybe the government finances the campaigns. Listen, you get 100 million, you get 100 million. Your job is to manage that appropriately. You can't take money from any outside sources because we know you're going to be indebted to them, quid pro quo. And then you might start seeing things that look a little more like they're on the up and up. I don't know, my silly thought. 1-year heat map, NVIDIA up 210%, still the big winner of the group. Oracle's now up almost 70%. Tesla, 69%, most of that, of course, being recent. Amazon, 47, Alphabet, 37, Meta, 81, Lilly, 41. And it's just been a sea of green. I hope you've absolutely crushed it for the last 12 months. Should have been crushing it for the last decade. We look at market breadth. We like to look at the number of companies hitting new highs versus new lows. 663 new highs on the New York Stock Exchange, 131 new lows. On the NASDAQ, 899 to 361. What a year it has been. Look at the black line here. So on average, the S&P goes up about 9% per year. We are up some 27%. And the Trump trade. So what's happened is we are abandoning all of the conservative sectors, healthcare, utilities, staples, and REITs in favor of financials, industrials, consumer discretionary, energy. That one's a little surprising. Technology, communications, materials. Lower rates favor small cap stocks. So when rates are going up, that's the dark color. And when rates fall, right, over a 6-month period. So you can see when rates are going down, we're getting rate cuts, clearly. Market goes up on average 13.65%, but small cap value stocks go up 19.44%. And the small caps have led the S&P and the NASDAQ post-election. Small caps are attracting a whole lot of capital right now. Biggest weekly inflow since July of 2024. And then financials, Biggest weekly inflow since January of 2022. I think we're going to see, the anticipation is lower regulations and more mergers and acquisitions, which will be good for the big banks who finance them and or make these offers available to the IPO market. Fear and greed index, you'd expect heavy duty into the greed. I'm surprised it's not an extreme greed, but that's a good thing. You don't want extreme on either side. And the rich get richer. 92.5% of all the equities and mutual funds are owned by the top 10% of the population. And this is where then the 90%, they hate the 10%. They vilify them. Listen, instead of trying to keep up with them in appearances, do what they're doing. Own stocks. It is good for your future. And on top of that, I would say learn how to trade options. History points to a melt up moving forward. So pre-election, generally the market goes up. After the inauguration, we haven't seen this yet. The market tends to settle a bit and then moves higher. Everything points to things getting better and better. Latest on what the Fed's going to do as of right now, there's a 34.7% probability there'll be no rate cut, but there's a 65% chance that we're going to get another quarter point cut. And then, of course, there's looks like 1, 2, 3 more cuts in the next year. 1 year sector return. So the S&P for the last 12 months is up 36.19%. So if you're trying to judge how well your broker has done for you or your advisor, if they're not up at least 35%, they'll underperform the average. Ergo, they are worthless and not able to justify them charging you fees. So this is where they should be. That's your benchmark. Big winners now, financials at the top of the list, followed by tech, communications. All those have beaten handily. Industrials has beaten, as has consumer discretionary. Everything else has performed below that, the bottom of the list being energy. And earnings this week, I don't see a whole bunch that is likely to make a big impact. Shopify might move the market a bit. Cisco, Disney on Thursday, but all the big stuff has already been announced. All right, let's take a look at the charts, see what's going on there. Let's look at the S&P 500. It's thing of beauty. For the last 6 months, we have lived above our 50-day moving average, which is bullish, of course. And we're well above the 50-day. The only thing I would caution you on, just my experience in making observations, the further we tend to get away from that 50-day, the more likelihood the chances of a pullback. So I would expect between now and the end of the year to, at least on a short-term basis, see some profit taking, and then the melt up should take place again next year. I'm not suggesting that anybody get out of the market. Just when it happens, don't be alarmed by it. But everything right now looks great. And it's virtually impossible to pick highs, I'll just tell you. And here's the NASDAQ. Rolled over a little bit so far today. Just a touch, but still, boy, look at that. All thanks to the election. So, in terms of our track record, I need to update this. But on a total of 74 closed trades, average return 18.9%. Average holding period 19.2 days. So, we're averaging about 1% per day. That's not to guarantee that that's what we'll do for the rest of the year, but those are the trades, such as they are. All right. Well, thanks for hanging with me. I will see you back again next week. Have a blessed week, a prosperous week. Bye for now.